Hi, everyone. It's John Pokorova. It is April 16th, 2022. Just thought I'd do a market update. There's some very specific things I wanted to get to today. So again, this presentation is made by Rain King LLC. I'm an amateur investor. I'm not affiliated with IBD or MarketSmith. So I quickly have the agenda set as to talk very briefly about the indices, and then I really want to spend most of my time talking about the bull market in commodity stocks. So the market environment right now, let's look at the indices. The NASDAQ is on the left. Last we spoke, we talked about they had broken through the 50-day, and you've noticed now that the follow-through day back in March, we've broken the lows, which is actually a negative sign. We gapped down through those. And what's a little more concerning is we haven't even been able to get any sort of rally yet. So it definitely kind of points to the odds saying that maybe we're going to go down and test these lows, if not break these lows. The S&P, which was the stronger of the two, even it has broken the 20-day and the 50-day. Both indices look vulnerable here. But let's talk about what is going on in other parts of the market. So I want to get into the commodity leadership, and I specifically want to talk about some of the underpinnings in the commodity space. We know that there's supply constraints globally. We also know that there's a rising rate environment, which is certainly not good for tech stocks, but it can be good for commodities. Inflation is a major problem. We're going to talk about that in a little more detail. These are all late cycle groups, but there's money flowing into them. And, you know, in addition to all of those underpinnings, you know, the Ukraine conflict is actually adding fuel to the fire. So let's break this down in a little more detail to really understand what's happening and expectations. So the underpinnings, the first thing I wanted to get into is this inflation. You know, inflation has become a major problem, and it's getting pretty sticky. One thing that was learned in the 1970s was, you know, inflation, if it takes hold, is very difficult to reverse. You know, these Fed actions that we're hearing a lot about, you know, quarter points and half-point hikes, that's not likely to get inflation under control. And what I wanted to share is the same chart I showed a week ago that, you know, showed the 1970s. In the 70s, 72, we had 3.4% inflation. And then things really started to get out of control, 8.7. And then 1974 was over 12%. And the initial reaction to that was the Fed moved from 5.75, you know, to 9 and 8%. And that helped, and it knocked it down a little bit, but you'll know that it didn't go away. Inflation came down to 7, then it went back up to 5, then it went to 7, then it went to 9. And you'll notice that in 1979 and 80 is when inflation was over 12%. And you can see the type of Fed action that it took to actually slay inflation when Paul Volcker, you know, finally said, we're going to have to raise the interest rates. And they got up to 18% to really break the back of inflation. And in 1982, things were really broken, and the big 1982 bull market started. So quarter point here and a quarter point there is not likely to get it done. The second thing I wanted to mention relative to this is, you know, the strategic petroleum reserves, you know, they get released. They've been released now. They've done this twice. In my opinion, this is just for show by the politicians. You know, they have actually released oil reserves twice, and I'll show you in a moment, oil prices are back to where they were. So it's only a short-term effect. And actually the oil futures are now reflecting the belief that higher oil prices will persist. So on this chart on the left, this is the US oil. This is a daily chart of spot prices. And I've marked when they did the strategic petroleum reserve. You'll notice the first one was back here. It knocked down things in a brief period of time, but then oil persisted higher. The second one was made towards the end of March, when President Biden has gradually going to be issuing release of reserves on a regular basis. So since that point, it knocked oil down for a while, but you'll notice that we're actually back above the line when the announcement made. So oil's come all the way back up to 103. Now, more importantly, I think, is the oil futures. Back in January and February, the futures were really reflecting that oil prices would come back down below 100 and stay there. But what we're seeing now, and this is an oil futures chart for looking at the contract for December of 2023. So this is over 18 months away. And you'll notice that, after strategic reserve number 2, oil prices on the futures market have come all the way back. We are almost at new highs in the futures. This is telling me that institutions are now coming to the reconciliation that oil prices, even into the future, are going to persist at a higher level. The futures are actually at new highs, even though the daily spot prices is not back to new highs yet. So what's the alternative to oil? Well, one alternative is coal, and coal is breaking out strongly. You can see here in the last week or two, coal has really broke out. Some of these names here, I've mentioned the tickers, they're actually breaking out and looking pretty strong. Coal now is actually stronger than oil. The chart on the left here, this is an ETF of uranium stocks, and you'll notice that uranium stocks have been outperforming the S&P for over a year. And you'll notice also, if you look at some individual tickers, some of these stocks have broken out. Either setting up in bases or they've recently broken out of bases. I just wanted to mention that, tech is, severely underperforming energy. As you can see on this chart on the right, tech is something really that should be avoided here. This is not a good place to be, and you really need to kind of wean off of trying to look at former tech leaders. I also wanted to mention, this is a chart of natural gas, actually an ETF of natural gas. You'll notice that these are moving to new highs as well. And here's a couple of the tickers, there's many others, but the important point is they are moving to new highs. So it's another area of the commodity market that appears to be getting stronger. So when you kind of put it all together, at least from what I'm seeing, this is a broadening of leadership in commodities, and that's a bullish sign. Not only do we have oil, but coal, the metals, natural gas, the fertilizers have been leading. And you'll notice that over the last 2 or 3 weeks, these indexes kind of have been consolidating. They had a run up, they consolidated for 2-3 weeks, and now they're all starting to look like they're going to move again. So it's a strong environment for the commodities. Now, I mentioned last time a strong market in commodities, could still also mean we are in a bear market, and other stocks are going to be really crushed. We know technology has been beaten up pretty bad. The 73-74 period of rising inflation, it was a 2-year grind down. It was an almost a 50% decline, 3 distinct legs, and it was high inflation and slow growth. But commodities did well. So it's counter to the major market indices, but it's something that we have to keep, that we could be in an environment that might be shaping up similar to this. Now, the commodity market, a number of people have been saying, well, is it early in the commodity bull market or is it late? So I'll just share my thoughts. A lot of people I'm talking to are getting worried that, oh, the commodities and oil names, it's a crowded trade, it's becoming way too obvious and it's going to be over. Again, my feelings about the news and the headlines. I don't think you should be paying a lot of attention to the news. We don't want to put too much value on opinions versus facts. And this article took a clip out. This is from Barron's. So you can actually Google this and find it on Barron's to read the full article. But essentially it says commodities are hot right now, but the party may be over, implying that this is going to be over with soon. And they cite that a number of institutional fund managers have been piling into commodities and becoming overweight in commodities. And this particular journalist thinks that we're near the end. What I wanted to emphasize is, Don't be scared out of a winning position based on news and opinions. If you have a good position in some of these commodities and it's in an uptrend, don't be too early to just get scared out of your position. And a couple of reasons why. One, as we spoke to last time, the funds are accumulating these stocks. The accumulation distribution rating in MarketSmith, which measures the last 13 weeks, most commodity names have an A or B rating, which are the strongest accumulation ratings you can have. Now, institutions don't tend to build big positions over a 2 to 3 month period with the intention of exiting those positions only a few months later. As I mentioned, oil futures were kind of an indication that people are seeing oil prices possibly persist longer than people anticipate. Also, we know that some institutions are moving aggressively into defensive sectors. The XLP, which is consumer staples, the utilities, the healthcare stocks, all very defensive in nature, and they're all getting a lot of money flow. And they're really reflecting a weak economy 6 to 9 months out. So try to not focus on the news and try to really watch your position and look for technical action. And the reason is trends can last much longer than you think. And so again, I'll advise you, use your instruments. What the commodity stocks, if and when they top out, and they will top out, make no mistake about it, we want to look for certain things to happen. One, the accumulation distribution ratings that I mentioned, they'll start to drop off. They'll turn from A's to B's and B's to C's as a warning sign that institutions are starting to distribute stock. We're not seeing that yet. We also might see an acceleration of the move higher. As last retail buyers see commodities as the only place to be, they'll start buying commodity stocks in concentration. And they'll be piling in, and that's usually when the institutions start to lighten up and sell their shares. But things we would look for is the acceleration might be moved by upper channel line breaks on individual stock charts, climax runs, widespread downside reversals would be a clue. And these are all, very offensive sell signals you should be watching for in your charts. Also, you might see 10-week moving average breaks on big volume. That would be a defensive sell signal, but also a sign that institutions are distributing and the cycle might be topping out. So we know we're in the late stages of the economic cycle. So we just know that commodities can work well, but you still need to be on your toes. So in summary, the NASDAQ, I believe, is very vulnerable here to a breaking the lows and accelerating a downside move. I really would caution to stay away from former tech leaders and bottom fishing. They're lagging. Now, commodities are in uptrends and they're working right now, but it's also important that you can't buy recklessly. You don't want to buy extended names, and a number of these names are extended. So you want to stalk the leaders in commodities. Don't buy the laggards breaking out last. You want to stalk your way and find a way to get into the leaders. In general, it's best to buy commodity stocks on weakness versus strength. So that's something to keep in mind as you're trying to find entry points. And always control your risk. These commodity stocks are very volatile. So you got to be very careful and watch your average cost like a hawk. You don't want to run it up too high, or these stocks will knock you out of your position. And again, use your instruments and avoid the news and the opinions of talking heads. They will generally be negative, and you want to stay focused on the action in your stocks. So that's my summary. I have one more other thing to cover that I wanted to get a straw poll on. Many of you have asked me about more frequent general market updates. I was doing them every 2 to 3 weeks. People are saying, can you do them more often? So I wanted to just get a level of interest. If I were to do 2 to 3 live recorded videos each month, which would be a 20-minute update, and then I'd actually take questions for 40 minutes to make it an hour, I'm interested to know, and if you can send me a comment or an email, would you be willing to pay $120 for an entire year subscription? I'm going to need to get more help to do more frequent updates with slide preparation and pulling information. So I'm just going to have to I'd have to charge to do that. Now, that would be approximately getting 36 videos a year, which works out to about $3 per hour video session. I'm just trying to see if there's critical mass to do something like this. So if you're interested, please send me a comment or a note. Let me know if you're interested, and we'll see if this has any legs. As always, this is my Twitter handle. Hopefully you follow me there or subscribe to my YouTube channel. Please hit the like button, and I will see you very soon on the next general market update.